$500,000 just vanished from your heir's inheritance, and your current estate plan did nothing to stop it. If you're a high-income professional with significant assets, you probably think estate taxes are only a problem for billionaires. That's the mistake that costs families hundreds of thousands in unnecessary tax liability. Here's what you need to know. The IRS doesn't care what you think is wealth. According to IRS Publication 559, any estate over $11.7 million in 2023 gets hit with a 40% federal estate tax on everything above that threshold. But here's the real wake-up call. That exemption drops to approximately $7 million in 2026, unless Congress acts. And for a high-income household with a $2 million home, $1.5 million in retirement accounts, $800,000 in investments, and $1 million in life insurance, you're already at $5.3 million. You're closer than you think. The delta between knowing this and doing nothing about it, up to $500,000 or more in unnecessary taxes that could have gone to your family instead of the IRS. That's where the Irrevocable Life Insurance Trust, an ILIT, comes in. And I'm going to show you exactly how it works, using a real-world case study that saved one family $750,000 in estate taxes. Let's start with the core problem. When you own a life insurance policy in your own name, the death benefit gets included in your taxable estate. At 40% tax rate, a $2 million policy costs your heirs $800,000 in taxes. But if that same policy sits inside an ILIT, the death benefit is completely removed from your taxable estate. Your heirs receive the full $2 million tax-free. That's the $500,000 swing right there for mid to high net worth households. Here's the real mechanism. An ILIT is a trust you fund during your lifetime, but once it's established, you can't change it or take money back, hence irrevocable. You transfer ownership of your life insurance policy to the ILIT. When you pass away, the death benefit flows directly to the trust, not to your personal estate. The IRS doesn't count it as part of your taxable estate. Your heirs inherit the proceeds estate tax-free. But there's a critical detail most financial advisors skip. The ILIT must be structured correctly, or the IRS will pull the benefit back into your estate anyway. Specifically, the trust must own the policy before you transfer it, not after. If you already own the policy and try to transfer it 3 years later, there's a 3-year look-back rule under Internal Revenue Code Section 2042. The IRS will count it as part of your estate if you die within that window. Let me give you the real-world math. A couple earning $400,000 a year had a $6.2 million estate, home $2M, 401k $1, 8M taxable investments $1, 2M, and a $2 million life insurance policy. With no ILIT, their estate tax liability was roughly $1.98 million at the 40% rate on assets over $11.7 at their death, assuming the exemption doesn't drop further. But they established an ILIT, funded it properly, and transferred ownership of the life insurance policy before the 3-year clock started. Result, when they passed, the $1.2 million death benefit flowed to the trust outside their taxable estate. Their heirs' estate tax bill dropped from $1.98 to approximately $1.48. That's a $500,000 plus swing, all because of one document and proper timing. Here's what you need to do right now. First, audit your life insurance. If you own a policy worth $500,000 or more and your total estate is heading toward $6-7 million, an ILIT is worth exploring. Second, talk to an estate planning attorney, not your general tax CPA, because ILIT require proper legal setup. Third, don't wait. The 3-year look-back and the 2026 exemption drop meantime is your enemy. The sooner you establish an ILIT and transfer ownership, the sooner it's protected. This is why high-income professionals who take estate planning seriously use ILIT. It's not exotic. It's not just for the ultra-rich. It's one of the few legally sanctioned ways to remove a major asset class from estate tax entirely. The gap between awareness and action is where most families leave money on the table. Don't be one of them. If you want the full implementation checklist and the step-by-step ILIT funding strategy, the complete breakdown is in the companion book, HSA Millionaire Hack, link in the description. The takeaway, an ILIT is not a luxury, it's a tax-protected wealth transfer mechanism available to anyone with significant life insurance and an estate approaching the exemption threshold. If that's you, the next 90 days matter. Subscribe for the next video dropping Wednesday. I'm breaking down the step-up basis reset loophole that could erase capital gains taxes on $500,000 plus in inherited assets. Ring the bell so you don't miss it. What's your biggest takeaway? Drop it in the comments. The tax code rewards those who study it.